Okay, it looks like we are live. All right, everybody, welcome to another Finance Friday. Right at 10 p.m. We have a couple of people logging in, but I'm going to go ahead and get started here tonight. And I'll go ahead and jump in with a quick introduction. So if you guys are watching, if you're brand new to this, I'm Jerry. I'm the owner and founder of Wealth Dynamics. Wealth Dynamics is a company that focuses on helping create financially educated and solvent families who achieve greater financial freedom in life. And so we do these webinars each week. The purpose of them is to create more financial education, to get information about money, information about finances, truth about money out there so that people can begin winning with it. Okay. Not only is that a topic that already doesn't get covered often enough, but in this specific period of time, I see an attack on money. I see, the idea that wealth is bad. Rich people are evil. Top 1%ers should be taxed more. We should feel bad for low producers. We should subsidize low wages, all of this other stuff. And I'm not going to get political, but what I want to point out there is the general consensus is that money is a bad thing. Okay, wealth is something to be ashamed of if you have it and be fearful of. It's not a goal. It's not something you should go after. And so the result is people aren't talking about money. And when we do talk about money, we do talk about finances. Unfortunately, it's in a bad light. Okay. So more so than ever, this has always been a course about how do we, continue to share the truth about money? How do we grow our financial educations? And that's always been the goal and the focus, but more so than ever, I think it's important right now to have a positive message about money. And for those of us that are watching, to share it, right? To share the stream, to share it on Facebook, share it on whatever mediums and channels we can, because the truth about money is something that is profoundly simple and it's profoundly impactful, right? It's this idea that we all go to school to get good grades, right? And that's the thing growing up. Go to school, get good grades. Why? So that hopefully we can go to college. Why do we go to college? That hopefully we can get a good job. Well, what is the purpose of a job? The purpose of a job is to earn an income, right? So we spend the entire first, 18 to 24 years of our life learning to go make money, but then we learn that money is bad, it's evil, it's wrong, and it's something we shouldn't pursue. How confusing would that be? Like how confusing of a message is that? So what ends up happening is we get it and then we don't care about it because it's like, well, I don't want to be materialistic and I don't want to be wrapped up in finances and money's not everything. And, there's other things that are more important. Money can't buy happiness, all of these things that we hear about. And the result is we end up squandering it and then we never actually become free from it. Okay, because there is some truth to it. We've all heard the phrase that money is a terrible master, right? But it makes an excellent tool. And so if we can learn to master it, we can actually have freedom in our lives. But the thing is we can't learn to master it if we don't understand it, if we don't talk about it, if we don't learn about it. So the purpose of this is to share that. Now, tonight I'm going to share something called the 40% rule. Okay. In my opinion, this is the single most powerful wealth building tool out there. And it's also the most overlooked. Okay. The 40% rule. What is that? Now, in order to understand, we have to look back at history. Okay. And I'm going to sketch this out. I don't have the actual graph on me, but I'm going to sketch this out, right? Actually, I might have the graph. Let me see if I've got this graph so I can just share the actual thing with you guys. Okay. So the first thing we've got to understand is we have to understand a little bit of history and understand where this 40% rule came from. Because again, guys, I am the CEO of Wealth Dynamics. I'm very smart, but this is not stuff that I came up with, right? If it was, you guys should all be very worried that we're taking financial advice from a 28-year-old that he came up with all by himself. This is not stuff I came up with, right? This is stuff that I studied and observed. And so I want to share with you the source of where the 40% rule comes from. Boom. So we can all see this, right? 40% rule. This is a graph. Now this graph, I'm going to break this down for you. The timeline at the very bottom, 1913, right? And it goes from 1913 until 2012. That's a 100-year period. Okay. Now what this is measuring is savings rates by wealth class. Okay. By decennial averages. So we're looking at the top 1% of wealth. This is our first study group. Okay. The next group we're looking at is the next 10 to 1%. That's a 9% spread. And then down here, we have the bottom 90% of wealth. Okay, this is measuring savings rates by wealth class. This is not measuring income. This is not measuring net worth. This is not measuring investment returns. This is measuring what percentage of income do they save pre-tax before they spend? Okay, now look at the top 1% here. Why do we look at the 40% rule as something that's important to follow? Look at their average. Okay, we measure their trend by decade. More often than not, they're saving 40% of their income, right? Early 1900s, right before the 1920s, they're saving 40%. Okay, they're saving 30 some odd percent in the 1920s. They're saving greater than 40% in the 1940s. 50s, they dip a little bit, still around 30%. We look at the 60s, they're saving 40%. We look at the 70s, they're basically saving 40% of their income. We look at the 80s, they're basically saving 40% of their income. It dips down here. We'll talk about that in a minute. And then we look at the 2000s, like 2010 through to the end of this period, they're saving 40% of their income. And it's not on this chart, but if we were to fast forward through till 2019, they were saving 40% or more. Warren Buffett, billionaire, I think at the time in 2019, he was the third richest man in the world. He admitted that he saved more cash than ever. He had like $160 billion sitting there in cash, right? Some crazy number. It might have not been 160. I think it was 120. Is like a massive amount of net worth sitting in cash in 2019. Okay, so it goes to show that we see this 40% rule and it consistently happens throughout time, right? And I think money is simple. I think wealth is simple. So when I look at this and I'm like, okay, they save 40%. There's a lot we'll talk about on this chart, but one of them is let's just copy what they do. If we just copy what they do, we're going to get similar results. If we also save 40% of our incomes, we probably will get similar results. Now, a couple of things that I've noticed on this, when I was looking at this, it was probably back in 2015, 2016, when I first saw this graph. Before that, no one had ever told me save 40% of my income. Okay. Prior to seeing this graph, what I heard was save 10%, right? Or save 20%, or put 15% in a retirement account, or whatever the thing was, right? And so no one ever came right out and said, no, you need to save 40% of your gross income. Okay. When I first saw that, I realized how underprepared I was with my savings. I was underdoing it. I wasn't saving enough money, right? And the reason why is I wasn't trying to build wealth at that point in time. If you think about, the idea of put 10% aside or put 20% aside, what is that actually geared towards? That's geared towards me putting money in a 401k and a Roth IRA. And then hopefully when I'm 60, I've got enough money there to retire. Guys, I'm 28. I love what I do, but I don't want to have to trade time for money until I'm 60. Okay, part of my story is my mom died at 60. She passed away at 60. I was her financial advisor. And so with the person that I loved the most in life at that point in time, I watched this entire thing of save money, put it in your retirement account till you're 60 and pay everything off. And hopefully you have enough money to retire. I watched it not work with my own mom. Okay. So when I looked at that, that was a wake up call for me. And then when I saw this graph, it was shortly after, and I realized this is how top 1% of wealth is built. Okay, it's not inherited. In some cases it may be, but in most cases it's not. It's not something that you win the lottery. It's not something you marry into. Like, these are all Cinderella stories. Like, the idea that I can win the lottery and be wealthy is a Cinderella story. Okay, the idea that I can just marry the right person and be wealthy is a Cinderella story, right? The idea that I have the family and assets passed down to me, that's a Cinderella story. Sure, it might happen. It didn't happen to me. Didn't happen to you guys. Right. So we have to really focus on, the reality of we've got to do this ourselves. We got to bootstrap it. And the way we bootstrap it is by saving 40% of our incomes. Right. So what I want to go over tonight is, how do we do this? Okay. How do we do this? And in order to know how we do this, we have to know why we would do it in the first place. Right. If you guys are anything like me, you're not going to do something unless you know why you need to do it, why it's important. I hated that growing up, do this, do that, but they never tell me why. And so as I became an adult, I really started asking why. Why do we do things this way? Why do we do things that way? Why would we save 40%? Yeah, the chart says to. Let me share it again. But why? Right? We have to know more than just, yeah, the chart says to. So check this out. Back to the chart. Saving 40%, saving not 40%, it dips a little bit. I want you to look at the time period. What happened in 1929? Okay, in 1929, the stock market crashed. One of the worst stock market crashes of all time. I think it may have been the worst stock market crash of all time. And so that's where you see this dip. This is measuring that full decade period. The early 20s was a period of prosperity. Money was cheap and easy. And so that's where you see in the 20s, they still were saving around 30, but in 29, it dipped. In 30, it dipped. And that's where you see they did start to drop. Now, what was interesting to me was 1930 through 1939. Okay, what happened there? I glanced at this for the first time. I saw it drop, but when I really studied it, I realized this is zero. This is the zero line. It didn't just drop, it went below zero. Okay, that's literally negative saving. It means that they're spending more than they're earning. Okay, they're not saving, they're actually borrowing money at this point, right? What happened here? This was the Great Depression. Okay, so what we see happen is the top 1%, they're saving 40%, they're saving about 40%, and then it drops into the negatives. Again, the first time I saw this chart, I was like, man, they got hit hard. I wasn't a top 1%er. I was still in that weird phase in my life where I knew I wanted wealth, but I also had disdain and you know, basically jealousy over people that had money. And so I was kind of like, serves those shitheads right. Hope they lost some money. Like that was the, you know, the inner, you know, poor person in me speaking at that time. And that was immature of me, but I looked at this later and I was like, wait, they didn't get hit. They were investing. Okay, a depression happens. What occurs during a repression or depression? Stock prices drop, real estate prices drop, competitors go out of business, talent from other companies, they're now unemployed and on the market. Everything goes down in price. And so what happened and what occurred, and I'm sure if this went earlier, we'd see the same trend, is they were saving 40% of their incomes the entire time. Everything went on sale, and they went as far as to borrow money to go buy it all on sale. Okay, and that's evidenced by the very following decade, their savings rate goes above 40% to an all-time high. Okay, this is the trend. And I want you to realize right now, we are in the 1920s type era, right? Lots of free money. Everything is cheap. Everything's going up. You can pick literally almost any stock, almost any crypto token, almost any property, and you're going to make money. We're in a increasing and growing bubble. And so right now, we shouldn't be buying these assets. We shouldn't be investing. We shouldn't be consuming. We should be stacking cash. We should be putting money off to the side, storing our value. And then when things crash, that's when we go hire our competitors. That's when we go buy stock on sale. That's when we go invest in real estate. Whatever your play is, the time to do it is not when the prices are the most expensive. Okay. Like I had someone message me on or comment on Facebook the other day. It's like, hey, I bought 2 fourplexes last year, you know, first investments. And, you know, after a year, they're already up $50,000 in what he called value. They're already worth $50,000 more. No. They're not worth $50,000 more. The price went up by 50,000. Price and value are two different things. If I bought 2 fourplexes and in a single year, they went up by $50,000 in value, I would be very concerned. I would be selling them quicker than you can imagine. Because the problem is they're not worth $50,000 more in value. Did the rents go up? Like, why are they worth that much more money? Right? The building is older. There's more of them available now. There's more of those fourplexes. All of the prices are high. Why are we paying this much money for an asset? Right? So we can look at this behavior and realize we want to stack cash when the economy is in a boom. Okay, we want to save 40% of our income so that when the economy goes into a bust, instead of panicking, instead of losing our jobs, instead of having our 401ks lopped in half, we can go jump into the market, whatever market that might be, and buy things on sale. Okay, let's look at this one. 1940s. Same thing. Boom. All the way up to the top. What happened in the 50s? There was a recession. Okay, the 50s, we had a recession. They dropped. Okay, they stopped saving as much. They're buying more. Right as soon as the recession is done, boom, back up. Recession. What happened in 99? Tech bubble. Recession. What happened in 2008? Recession. If you saw this graph in 2020, recession. I guarantee 2020 would dip. Right? So it's something that it happens consistently enough that I looked at this with my own finances and I was like, if I do nothing else, I'm going to do that. Right? If I learn nothing else about wealth, I'm going to make sure I follow that rule. And so that's what I've strove to do the last 5-10 years of my life, is really pushing to save 40%, really pushing to follow that rule. Right. And so what we have to do is we have to look at the reality of getting there. It's tied to the motivation to get there in the first place. Right. We want to get there to build wealth. We want to get there because in 2020, the banks made more money than ever. In 2020, Elon Musk made more money than ever. Jeff Bezos made more money than ever. The top 1%, Mark Zuckerberg, these guys that we hear about, they made more money than ever, when all of us, excluding myself and many of my clients, we lost money. We lost jobs, we lost money, we lost income, we lost our 401ks. We lost a lot in 2020. It didn't have to be that way. right? It didn't have to be that way. It could have been something where we actually profited from that event occurring, but only if we have capital set aside, only if we have money to put to work and put into deals, right? So how do we do this 40% thing? First, we have to actually be on a forced savings plan in the first place, right? In order to save 40%, I have to save something, right? And saving is something that I do on an automated basis, right? So it's important to realize when I talk about saving money, we're not talking about this. Let me sketch this out, because I think when I say saving money, this is what a lot of people think of. They think about, I earn income, comes into my bank account. Step number 2, I pay bills. And then step number 3, I have leftovers. And I save the leftovers. I put the leftovers in my savings account or in my IRA, and I save the leftovers. Guys, this is not lasagna. We're not saving leftovers. In order to save 40% of my income, what has to happen is income comes in, right? And we forget about leftovers. Income comes in, and then off the top, we save before bills. And we save off of our pre-tax income. You're not probably going to start at 40. You might start at 5 or 10 or whatever the number is going to be, but you have to start, right? The 40% rule doesn't exist. It's like first is going to be the 5% rule or the 10% rule, but it's the behavior of when I get paid, I save first before I pay my bills, before I pay my mortgage, before I pay my taxes, before I put money into anything else in my life, I save. Okay, now I want you to think about when we hear people talk about saving on social media right now. What are we hearing? We're hearing savers are losers. We're hearing cash is trash. We're hearing, don't put your money aside and save for a rainy day. Put it into assets, put it into courses, put it into this, put it into that. Those things are good. And I'm not saying you shouldn't invest in yourself and into other stuff, but I'm saying saving is not for losers. We just looked at the top 1%. They save 40% of their income. If saving was for losers, why the hell are the wealthiest 1% in the country saving 40% of their income? Like, wouldn't they avoid saving at all costs? If cash was trash, wouldn't they want nothing to do with it? Right? I posted the other day, if cash is trash, like, by all means, I'm the garbage man. Like, bring it to me. If you don't want it, I'll take it. Right? Because the reality is we know that's not true. We know that it sounds cool. It's great motivation for Facebook posts. It might sell ads, but it's not true. Okay. True is cash is debt. If you really understand currency, you know that the US dollar is actually a debt-based currency, and that's how it exists. And that's a true statement. Cash isn't trash though, and savers aren't losers. Okay. So that's one thing, is we have to actually pay ourselves first, right? So we put the money aside immediately upon earning it, right? So that's the first thing, is pay ourselves first. Pay yourself first. Okay, now I want you to think about what would be the second step here. Okay, we think about this phrase, pay yourself first, right? The thing that sticks out to me is the word yourself. Okay, meaning the money actually goes to yourself, not to someone else, right? When I think about if something is mine, right? Like this cup is mine. Why is the cup mine? Because I can control it. I can have it. I can touch it. I can access it, right? So the cup is mine as much as I can have control over it, as much as I can have access to it, right? As much as it benefits me as well. I drink water from it. It helps me, right? So when I talk about pay myself first, it's not just what I'm keeping, it's where I'm keeping it. I need to make sure that I'm keeping it where you keep it. I'm going to put that as step number 2. Okay, because we've all heard that it's not just what you make, it's what you keep. That's true, but it's also not just what you keep, it's where you keep it. So if I'm paying myself first, but by paying myself first, I mean I'm actually giving my money to Wall Street and I'm putting it in a 401k and I can't touch it till I'm 60. Did I really pay myself first? No, I didn't pay myself first. I paid Wall Street first, right? If I put it in a bank account and I put it in savings, right? And I find out that the bank, they're doing something called fractional reserve banking, and they are loaning my money out to other people and risking it and day trading with it and giving it to hedge funds, and they're paying me nothing, and I benefit zero on that transaction. Did I really pay myself first? No, I paid the bank first, right? If I'm looking at this from the standpoint of, okay, when I get paid, I have my taxes withheld from my paychecks, and I get a tax refund every year, and that's something that I'm celebrating, and that's my way of saving. Did I really pay myself first? No, I paid the IRS first, right? These places that we put our money, these are not us. This is the IRS, this is banks, and this is Wall Street. Those are the three groups that get the majority of all of our money. Think about it. The fourth one we could add is insurance companies. And I'm not talking about insurance companies that you save money with, like a life insurance policy. I'm talking about like health insurance, auto insurance, all the insurances that we have to pay for that we don't get anything from as a benefit, right? But the big three, Wall Street, banks, and IRS. Okay, so I am not paying myself first if my money goes to them every month. If I'm putting money in my 401k, that's not paying myself first. That doesn't count towards the 40% rule, right? If I'm putting money in savings, that doesn't count to the 40% rule. And usually I'm not putting in savings first. I'm putting my leftovers in savings, right? If I'm giving it to the IRS, that doesn't count. Like when I get my refund, I don't get to include that as the 40% rule, right? So where should I be keeping it, right? So this is a big component. Where am I keeping it? And it's a lot more motivating to save money when you actually have control over it. Like when you know for a fact that I can access it, it's mine, I have control over it, you're going to want to save more because you're like, man, I can see, the cash value of my life insurance grew by $20,000 in contributions. I could go get that money tomorrow if I wanted to. That's a different feel than it's in my 401k. Yeah, it's digits on a screen, but it doesn't actually mean anything to me. And it's also a different feel than, oh, it's in the bank, I can get it, but it doesn't grow, because in the life insurance, it grows, right? So that's the second thing. The third thing is storing value. Okay, this kind of goes along with where you keep it, right? Storing value. There's a difference between money and currency. And this is something I didn't learn even as a financial advisor. This is something I had to learn myself. The difference between money and currency. Okay, currency is a transfer mechanism. It's like a check system. Meaning like AJ, he performs a legal service for me. We don't barter, right? I have to pay AJ money for that. And so he's going to say, hey, I want US dollars. I want them now, like immediately, so I can perform the service. And so I send him currency, right? Now, currency is not backed by anything. Currency, as we know it today, the US dollar, is called a fiat currency. Fiat means by declaration of the government, meaning the reason why we use dollars is because the government has a gun to our heads and says we have to. Okay, that's the only reason they're valuable, right? The dollar used to be backed by gold, right? So money, or a store of value, is something that may or may not be used as a transfer mechanism, but it does store value. Meaning, when I keep money in savings, it should actually increase in value, and hopefully at a rate higher than inflation, right? Now, if we're in this deal, me and AJ, and I pay him currency, what's going to happen to AJ's currency if he keeps it there? Right? If AJ keeps it in currency, it's going to go down in value, right? That's called inflation. Inflation is actually a dressed up word for something called currency devaluation. Inflation, prices didn't go up, the dollar buys less. We all are experiencing that. You can see all around inflation happening, especially this year, right? So it's not because bread is worth more. Bread is not worth more. Factories, technology, like all of the stuff that we have to optimize the bread making experience should say that bread costs less because it costs less to produce. So why on earth did the price go up? Well, it's not because bread is more valuable or harder to produce or more scarce. It's actually because the dollars we buy with don't buy as much bread. It takes more dollars to buy the same bread, which means that the dollar went down in value, which means if I'm saving in currency, I am losing value. Okay, I'm actually going backwards if I'm saving in currency, right? Like cash isn't trash because you wouldn't throw your money out. I mean, some of you guys might. If we looked at your debit card and credit card bills, it might look like you're throwing money out, but none of us would take a dollar and crinkle it up and throw it in the trash because it's trash, right? But we would keep it and it would go down in value because it's debt, and the inflation is the interest we pay on that debt. Okay, money is literally currency. US dollars literally borrowed into existence through the Federal Reserve Bank and the United States Treasury. It's literally a loan, which is why there's inflation, which is the interest on it, right? So we want to save in stores of value. My two favorite stores of value are bullion and life insurance. Okay, bullion and life insurance. And I should actually put the life insurance first. I'm going to do that because I think that's from a risk mitigation standpoint, that's a less risky asset. We have life insurance and we have bullion. Right. And I don't mean bullion like the soup cubes, right? Those of you guys that are cooks, it's not like the little chicken soup cubes. This is gold and silver. Okay. And then life insurance, this is specifically high early cash value HECV. Okay. And it's got to be dividend paying. Okay, these are my two favorite stores of value. So to answer Justin's question, does it count? Do my life insurance premiums count? Yes, they do. Okay, because those are actually going into a store of value. It's something I control. So when I'm saving and I'm trying to get to 40%, it's motivating to have, it's paying me first, right? It's going into a real store of value. And that's going to cause me to want to put more of it away because it's a good thing. Right? Like think about, for those of you that have ever gone to the gym and lost weight, when you see the scale go down, what happens? You're like, man, I'm going to work out harder. I'm going to do better on my diet because I'm seeing progress, right? When do we dwindle on stuff like that? It's when the scale's not budging and we feel like it's all for nothing. And you know, we're working out and we're dieting, but we're just not seeing results. And that's usually when we're like, man, that cheeseburger sounds good right now. And I don't think I'm going to go to the gym tomorrow or the next day because I need a break because I'm stressed out from all this working out stuff. There's no positive reinforcement. So what I'm here to tell you tonight is when you pay yourself first, meaning you put the money in a location that you actually control, you actually profit from, and it's a true store of value, you will automatically save more money because you can see the positive benefit. I can tell you, like for years, guys, case after case, client after client, I can show you, they start a sacred account, they save more money because of it. They start buying gold and silver, they save more money because of it. I have a client right now that every single week, this guy texts me, $2,500 bullion order. Every single week. He's like, happy Friday, Jerry. I'll see you at course tonight. By the way, let's do 2,500 in gold. Okay. And he's not, you know, a millionaire yet. He's not somebody that's making $500,000. This is a guy that works his ass off. He makes a good income, but he makes sure that he pays himself first. I guarantee he could buy other things. He could go on more trips. He could do whatever, but he puts it here first because he has the goal of financial independence. This goes back to what I said on 4th of July, guys. We are in financial prison. The way that our banking system is set up, the way the markets are set up, we're not financially free. Okay, we're financial pawns to the top 1% of wealth that own the systems. By the way, most of them are politicians. And so the only way out is to break out. And so the intensity and the fervor that you have in actually making that happen, you know, it's a behavior. One of those big, shovels that you could use to dig under that prison fence is the 40% rule. The bigger your savings rate, the bigger the shovel you're digging with, right? So this is something that we look at. We want to make sure that we're putting it into a real store of value. Now, as we're going through this, we have to look at also the blueprint phases, right? So when we look at our blueprint phases, we've got to understand kind of the sequence of things. And I'm going to pull this up because this really coincides with the 40% rule. All of this stuff is actually geared towards this on your early blueprint steps. And a lot of people may not have realized this yet. And if you don't know what I'm talking about with the blueprint, we have this thing called the Blueprint to Financial Freedom. And it is a step-by-step plan that if you follow it, go through the phases step-by-step, you will gain financial independence and greater financial freedom in life. Now, think about phase 0, right? Phase 0, personal financial purge. Who's done this before? On Wealth Dynamics University, who's done the purge? Okay, I know some clients on here have, right? Mark's done it. I think Avery's done it. I think AJ has done it. I think Justin has done it. I know Ryan has done it. Like we have tons of clients that have gone through this. The purpose of the purge is to get rid of all the excess crap so that you know what you're working with, right? You have your income, you have your expenses, and now you can analyze and look at, okay, how much can I actually save on this current income and current expense plan? Okay. So we start going through, okay, how do we pull out the garbage so that you can put more money aside and save more? That's the purpose of the purge, right? Wealth Dynamics University, you start learning about gold and silver and going through our sacred account course and certification. That's going to give you education on, okay, now I know where I'm putting this money that I'm saving. Then we get you with Mint Builder, precious metal subscription. Like I said, very first step, start saving in gold and silver. The reason why we do this first is it's immediate. Those that have set up a sacred account, you know, it can take, some people have the shortest one we've done a month. I was amazed. Okay. Longest one we've done was like a year. Okay, so underwriting can be all over the place on how long it takes to set up that sacred account. It can almost be demotivating to start and be like, hey, I signed up for a sacred account, but I still have to give my money to the bank for the next 6 months or the next, 4 months. So that's why we do precious metals in the interim, so that you can actually have real money, tangible money, and actually start saving in something outside of the banking system. So that builds that muscle. Then we get into handling debt, right? We get into how do we get rid of your debt so that you can free this up. You have student loans. We're working with a client right now. He's got student loans, I think about $250,000. And so we're going to enroll him in our MPA debt resolution program. We're going to lop the debt in half, and then he's going to pay it off in 4 years, right? So when he pays off that student loan, he now has income freed up to continue in increasing that 40% savings rate, right? So that's something that we're looking at, the sacred account. The purpose of that is to have somewhere to put the money as we pay off the debt and get, debt free and save more of our income. Taxes. Why do we do tax planning? Tax planning is not, to give you some complex strategy to brag about with your golfing buddies. Is so that you can save more money, right? The less you pay in taxes, the more money you can save and invest, the more debt you can pay off. All of this is geared towards that. The insurance cost analysis. We go through a rundown called DITICS, DITICS, right? So we go through debt, insurance, taxes, investments, cash finding, and the subscriptions. So there's 6 areas that people overpay. We go through a rundown to reduce those costs so that you have more money to save. All of this leads up. We get into credit, right? If you don't have your credit banking done, that's another thing we're going to work on. That helps us accelerate debt, helps you save interest when you do finance things so that you have more money to save. All of this leads up because by the time we get over to phase 1, we're going to the sacred account premium. We have more money we can save. We're putting away probably several $1,000s per month in sacred account contributions. We get into phase 2. We're starting to buy gold on a wholesale basis, meaning we're buying, like my client doing $2,500 a week. He's buying at a discount. He gets better pricing because he's buying in that volume, right? We then get into, the home equity line of credit strategy. The purpose of that is to reduce your housing cost so that you have more money to save. Advanced tax planning, again, more money to save. All of that leads up to doing our first deal. Why do we do our first investment deal? Why do we invest for passive income? Okay, initially, it's not financial independence. That's not till later. The reason why we do it initially is so we can save more. We're going to save 100% of that passive income and we're going to reinvest it, right? So when we get 50,000 and we do our first deal, you're making $500 a month. You're not rich. Like by no means are you going to roll around in a jet. You're going to be the same guy with $500 a month more and $50,000 less in his accounts because you've invested that money, right? So it's about how many of those deals can I do, because that 40% rule is easier when I have passive income showing up. And so then we get to phase 3B, which is the 40% savings rate. Okay. All of that, every single thing that we do prior to phase 3B, the entire purpose of it is to save 40% of your income. Okay, 100% of it. It's all aligned to that one goal. Because I know if I can get you there, then I can get you doing 1 to 2 deals a year. And then it turns into 3 to 4 deals a year. And then it turns into 5 to 6 deals a year. And then it turns into 12 to 15 and then 20 and then 30 something deals a year. And then you're financially independent and you never have to trade time for money again. That's the way you get there. Okay. So the blueprint is a strategy to help you achieve that 40% savings rate. Okay. Everything prior to 3B, that's the goal. Now, what I want to talk about tonight is how do you enhance that? Because if you're a client, you're going through your phases, how do you speed things up? Okay. How do you go faster? How do you get to 40% sooner? Okay. This comes down to one thing. Okay. Behavior. Right? There's 2 things I can control with my 40% rule. I can control my income and I can control my expenses. Right? So if I'm on phase 0, right, I'm not yet going to be doing, tax planning. I'm not yet going to be doing a home equity line of credit. I'm not yet going to be doing some of these advanced things. Like on the home equity line of credit, it's amazing. Like you're paying $2,000 a month for your mortgage. We do a home equity line of credit. We do the RIM loan is what we call it, RYM. And now you're paying $600 a month for your mortgage. And you've freed up $1,400 a month that you can now save. That's incredible, right? That makes it very easy to save 40%, but you've got to get there first. So how do I get my 40% rule happening sooner, even if I'm not at that phase yet? Okay. I can behave differently. Okay. And this is the boring talk about money that nobody wants to have, but it's the truth. You earn more income, meaning you work more, you sell more, whatever you do to earn income, you do more of that. Okay. And I know we've got some heavy hitters in the comments, some people that earn good income and they understand exactly what I'm talking about, right? You earn more income, but you also have a monitor on your expenses. Okay. You track your expenses. You use our big 3 challenge journal. You actually log on a 1 to 5 scale and you rate your expenses on a weekly basis, right? Now there's 2 schools of thoughts here. There's, the income people that are like, hey, just out earn all your expenses. Been there, done that, right? And then there's the Dave Ramsey people that are like, no, be frugal and do the beans and rice thing and budget. Okay, what I'm here to say is, what if you did both? What if you earned maximally and you also budgeted maximally? Right? Like, what if you did do both? Because this is what Fortune 500 corporations do. They're not out there blowing their wad on stupid stuff with their expenses, and they're not also sandbagging. They're trying to get their income up. Okay, so what if you did both? What if you maxed out what you could earn? If you're in sales, you double your call volume, you double the amount of demos and appointments you have. If you're a service provider, I have a client here that's a doctor, you double the amount of appointments you're attending, and you just push as high as you can to get your income up. If you're in network marketing, you freaking go out there like you're brand new and broke, and you recruit and you sell as much as you possibly can. And then you go home and you keep all of it. Okay, you reduce your expenses down. Okay, you try and keep as much as you possibly can because you're trying to get to 3B. Okay, this is on the income side. What happens is burnout. A lot of people don't realize you don't have to do this forever. You don't have to do, doubling the income and everything forever. You just have to do that until you get to the point of getting on 3B and then getting to phase 4 and being sophisticated. Okay. And if you do it more than that, by all means, but a lot of people think, if you live by the sword, you die by the sword. If I sell, then I'm stuck in that lifestyle and I'm going to be the 60-year-old realtor that can't retire because all of my money is dependent on sales. No, we're trying to get you out of that. By investing, you start building, if you will, a salary of passive income. And then you can start to back down your production and say, hey, I don't have to trade my time for money anymore. If I want to go kill a deal, I can, but that's totally optional. If I want to go build a business, I can, but that's totally optional. Right? So that's one thing, is people avoid increasing their income because they're afraid they won't be able to keep it up. Okay. Who's ever had their best month ever? And then you were actually nervous about the next month because you're like, man, I don't know if I can do that again. Okay. What if I show up with lower numbers? Right? Okay. So this solves that, because if you get to 3B and you hit 40% of your income and you start investing for passive income, there's some alleviation that happens that, okay, my income is not all tied to my production anymore. I'm buying myself out of having to trade time for money. Okay. Now on the expense side, what people are trying to avoid here is they're like, man, I don't want to be frugal my entire life. I don't want to penny pinch. I don't want to be that person that's 70 living on cat food. Right. I promise you that's not the plan that we're doing. Do this until you get to 3B. 3B is the 40% rule. So you're not doing it forever. We're not saying, scrimp and penny pinch forever. We're saying, like, reduce your expenses down as low as you can, right? Until you get to 3B. Once you're on 3B, guess what, guys? I don't have a budget. I know we have the PFP and we have the big 3 challenge. I don't use those because I take 40% off the top and then I spend whatever the hell I want to after that. Okay. Like dead honest, I don't budget anymore. My company budgets, right? We have accounting and bookkeeping and all this stuff, but I don't personally operate on a budget. If I want food, I buy it. If I want to go somewhere, I go, right? As long as I pulled my 40% off the top, whatever's left over is fair game, because either I'm going to spend it or the IRS is going to tax it, right? So if I can spend it quicker than they can tax it, I'm going to do that, right? So when you get to 40%, you don't have to worry about the budget anymore. This is a temporary means to an end. Okay, and it goes back to, how intense are you about getting financially free? How important is it for you to get out of the prison? Okay, how important is it for you to dig out? How important is it for you to no longer have to trade time for money? Like, I want you all to think about, right? Tonight is Friday. Tomorrow is Saturday, Sunday. For those of us that are entrepreneurs, that means nothing. But for those of us that have a job, that means Monday is coming around. Imagine Monday, you don't have to go to work. And Tuesday, you don't have to go to work. And Wednesday, you don't have to go to work. And Thursday, you don't have to go to work. And you never have to go to work again. And if you decide to, it's because you want to, because you enjoy it, because you can add value. And it has nothing to do with paying your bills. Nobody can tell you anything. They can't make you work late. They can't make you work harder. They can't make you do jobs you don't like because you're like, hey, I'm not obligated to a paycheck. I can literally, like if I'm AJ, I'm an attorney, I can volunteer. I can show up to the firm and be like, hey, I'm here to do X, Y, and Z, and then I'm out. Okay. Like right now, I might not be able to do that because they have me on salary and they own my time for a certain amount of time a week. But if I'm like, hey, I'm a volunteer, like I'm going to show up when I want to, I'm going to leave when I want to. I just enjoy law. That's a different feel. That's a different vibe that you've got, right? So you want to get to that point of, okay, I'm saving 40% because at that point in time, I can spend whatever's left over. But until that point, I want to look at every single thing that I can and keep as much as I can. Okay. Now it's going to be both. You have to earn more income and then you have to reduce the expenses. And if you want to get there fast, that's the way to do it. Okay. Because some people, your W-2 job, you're a salary, and you look at the expenses first. Okay. You can do damage there for sure, right? You can cut the bills down. You can get rid of subscriptions. You can eat out less. You can do whatever you want to do there. You're going to save a couple hundred, maybe $1,000 a month. I've seen 1,500 or 2,000 for people that are really bad spenders and over consumers. Okay. That's great. Some people are gifted in that area. Others, they're maybe in sales or they're an entrepreneur and they're going to say, okay, I can go close 5 more deals next week. Okay. I want you to take both of those and combine them. Again, if you're married, maybe it's, one of you guys is one of the is the other, and you come together as the super team. Okay. But the bottom line is you have to create margin. If you look at a company, again, a Fortune 500 company or a bank, they're watching their cash flows. They're watching their expenses. They're watching their income. Okay. So how do we get there? We force it. We make it happen. We make it happen until we get to that 3B point, right? And then as you're going, like, we'll grease the lines. We're going to help you reduce your taxes. We're going to help you, get rid of your housing costs. We're going to help you reduce your debt costs, right? Like the debt program we have with MPA is freaking phenomenal, right? Like I have a client, we just cut his debt payments in half instantaneously. He's able to save all of that extra money now, right? But if you want to get there quicker, I'm telling you, that's the extra juice. Okay. Now, the other thing that this comes down to is income and expenses. And this one might sting a little bit. Income equals production. Okay. Expenses. What is the opposite of income? Expenses. What is the opposite of production? Consumption. Okay. If I'm spending more than I earn, it means that I'm a consumer, not a producer. If I'm earning more than I spend, it means that I'm a consumer, not, or I'm a producer, not a consumer, right? So what I'm really telling you here is, in order to be in the 40% club, you got to be a producer. And you got to be a producer such that you have 40% margin left over. Is that not what a top 1%er is? A producer. Somebody that produces so much more than they consume that they have that much more money to put aside and produce more with. Okay. Now, I'm not telling you you can never enjoy it. I'm saying when you get this 40% rule down, when you become financially independent, okay, down the line, we're financially independent, which equals, again, PI greater than set. This passive income is going to cover savings first, which is 40%, right? The reason why we do this is that keeps you financially independent. If I have, let's say, $20,000 a month coming in, what is 40% of that? $20,000 a month at 40%, $8,000, right? That means that I'm saving $8,000 a month. Okay. If I do a deal at 50,000 every time, and I'm saving $8,000 a month, that means that when I am financially independent, immediately I'm doing a deal every 6 months. Okay, I'm outpacing inflation by investing that frequently. If I don't have the habit down of saving 40%, like, I'll probably never become financially independent. And if I do, it's going to be short-lived because I'm going to spend on expenses and taxes, and my saving is not going to keep up with inflation. And eventually my expenses and taxes will surpass my passive income, and I'm going to have to go back to work. Right? So this is not just something we want to do prior to being financially independent. This is a behavior we're building it. Behavior is the brain's way of automation, right? It's way better than AI. Like if you've ever had a bad habit you couldn't kick, It's like freaking clockwork. Like you don't have to think about it. You're just automatically doing that thing. If you've ever been able to master that with good habits, same thing. It's like clockwork. Waking up on time. I know people that 4 a.m. they're up out of bed, right? They don't have to think about it. It just happens. Going to the gym, boom, they're down there doing it. Making their calls every day, boom. It's not something they have to think about. So we want to do the 40% rule, because when you do 3B, well, you've still got to get from 3B to 6, right? Phase 6 is financial independence. Phase 6 means I'm no longer trading time for money. That's 3 more phases. That's a couple years worth of you saving 40% of your income every single week. Okay, by the time you get to phase 6, that's going to be a habit and you won't have to think about it. Meaning you're going to be financially free now and forever because you're just used to taking 40% off the top, right? Just like people are just used to paying taxes. People are just used to putting money in the 401k. If it happens on an automated basis, you don't have to think about it. It just occurs. Okay. Like show of hands in the comments. Those of you that have sacred accounts, who has had this experience yet where you kind of forget you had it, right? Like you like, obviously, you know, you have one, but you forgot it was there. And then when you look, you're like, oh damn, I have, 60 grand. I have 100 grand in there. I forgot that I had that money. Right. Or you forgot you had gold and silver. And all of a sudden you randomly just decide to check the price of gold. And you're like, wow, I have $40,000 worth of gold. Right. Who's had that happen? Because it's the same exact thing with passive income. Okay. Except for you're spitting it off every single month and it's something you don't work for. And then you look and you're like, oh, it's time to do another deal, but it's time to reinvest. Okay. And this then leads into, we won't go into this tonight, but this leads into the need to build a family office. Okay, the need to build a family office. A family office is when you take your assets and your investments and it's producing so much income that you actually hire executives to help you run it as a business. Right? Like that's a family office. You would get to the point where every 6 months immediately, like again, you're doing 20,000 a month in passive income, you're saving 40%, that's $8 grand a month. That means in 6 months, you're going to do a deal. In 6 months, you're going to do another deal. It's going to get to a point where you're doing so many deals, you can't personally keep up with them all. That's a good problem to have. Now you're going to need to hire an assistant. Now you're going to need to hire an executive, someone that keeps maybe keeps track of your bookkeeping. You're going to need to hire someone that helps you vet deals. You need to hire someone that helps you find deals or find financing. And you end up with a company that is your family's wealth, right? That happens because of the 40% rule, because you're profitable, because that's really what it comes down to is I live a life that is profitable. Meaning I have surplus above my expenses because of my income, because of my saving habits, because of my investing habits. And it all comes down to knowledge and behavior. Okay, what do I know and how do I behave because of what I know, right? All of us know this, but if we're not behaving with it, there's something we're missing. And that's what I want to end with tonight is if I'm not saving 40%, I should be taking an honest look at why. Because I showed you how to tonight. I showed you why you should. I can't make you do it. Okay. At the end of the day, I've got to get through my blueprint phases faster because Jerry and the team help me with the 40% rule and freeing up money when I do that. And I've got to go home and behave like it's game time. Meaning I earn the income, I keep the money, I lower the expenses, I do what I've got to do to get to phase 3B because it gets easier at that point. So guys, what I want to do is I'm going to wrap up here for tonight. What I want to do is take some questions. I know I did a lot of communicating and talking. I would like to know what your thoughts are. I want to know, what your, maybe obstacles are, problems that you're dealing with, questions that you have on trying to save 40%. And it doesn't matter what blueprint phase you're on, or if you even know what the hell a blueprint is. I just want to know what your thoughts are and be able to help out tonight. So let me jump into the comments first on Facebook. And let's see what we have here. Good to see everyone tonight. We've got Steve, good to see you. Justin, good to see you. Ryan, good to see you. Daniel, good to see you. Daniel actually is an amazing success story. Daniel, he's someone that from the get-go, like immediately understood the 40% rule. I'm not going to give you numbers. I'm just going to tell you, since working with us, his net worth has literally snowballed like at a greater rate than it competes with most of the ones I've seen. Right. That's like Daniel automatically gets it. He tracks it. So he's a prime example of someone that, really does apply what's being taught. Justin says reviewing my financial blueprint regularly is extremely motivating for me. That's awesome. That's exactly what we want to hear. All right, let's see what we have on Zoom. All right, real quick, I'm going to switch my mic over on Zoom so that there's not any echo or feedback. Okay, so let me check here on Zoom. Let me know how I sound if you guys can hear me okay now. All right, so we have some questions. Mark says audio sounds good. Excellent. Good to see everyone on Zoom. Let's see what questions we can answer tonight for people. Okay, we have a question from Mark. Let me bring Mark on live here. All right, how are you tonight, Mark?
Hey, Jerry, nice to see you again. I look forward to your meetups every Friday. You're a great motivation for me. My question, you basically answered. My concern is my sacred account. I pay my deposits on a yearly basis. So during the year, my part of my 40% of savings, like you mentioned, I'm putting it in a bank account to accumulate until my yearly premium is paid, and I do realize that I'm losing some of it every month due to inflation. But my concern is if I do switch it over and buy bullion and accumulate say 1 ounce per month for 12 months, when I do have to pay my premium and I do liquidate the bullion, I'm concerned about the price not being where I need it to be to pay my premiums. You understand my point?
Yeah, exactly. And Mark makes a really excellent point. So Mark is saying he pays his premium annually, which means once a year the entire thing is due. I do the same exact thing, Mark. So I have the same setup with mine. The benefit on that is with an annual premium mode, oftentimes you get a discount on the premium cost, meaning you've got more money that shows up in cash value, not by a ton, by a little bit. It's like when you buy car insurance. If you pay for the entire year, it's cheaper than if you pay monthly. So I do annually because I get that small discount. Now, I already know what I'm going to have to fund by the end of the year, right? And so what I do is I make sure that I'm setting that aside. Now, I buy anything beyond my sacred account, I buy gold with, right? So Mark is right. You don't want to buy gold where you're going to have to sell it in 12 months. Okay, you also don't want to buy gold and borrow against it to fund a sacred account because it doesn't pay itself back. So what I would do, Mark, is I would either do one of two things. I would have a set aside account where every week I'm putting aside 1/52nd basically of the entire annual amount. And, if that can be in a high yield account, great. I wouldn't put that to work or put that at risk anywhere because you don't want to have that money gone basically by the time you have the sacred account funded. But then really make sure that anything beyond that number is getting set aside into gold and silver or other stores of value. So that's the first thing I'd look at. The second option would be if you're on a variable income where, let's say your sacred account premium is, let's say 100 grand for the year. If you know you can make that in a month, right? Just buy gold all year long. And then December, when your premium is due, just make sure that you go make the 100 grand. And that's something that's a little more risky, but that's also an option. So that's also like when you're at 3B, we have a couple solutions for that for our clients because the goal is we do want them paying the premium on an annual basis. All right, great question from Mark. We've got Nano. Nano says, I am the 5 a.m. guy. Nano doesn't sleep. Nano just waits, guys. He just ready to go already. All right, we've got a question from Nano, actually. Let me go ahead and bring Nano on live here. Hey, all right, we're live with Nano. How are you tonight, Nano?
Doing great, man. You?
I'm awesome. I think your question is probably for someone else, but it's something you're asking. Is that right?
Yeah, sure. Because you raised the question, if I'm not saving 40%, why not? Right.
Yeah.
But also, dealing with few people and clients, and even people who tend to be on the stream here for quite some time, tend to save their money or whatever they make, but in cash. But for whatever reason, they just don't seem to pull the trigger to anything else, right? Which is more of a how can we address that type of a deal?
Yeah, so that's a great question. And Nano's our head of sales, so he deals with a lot of conversations with people, educating them on why they should have a sacred account, why they should be using gold and silver. Now, I've been someone that hoarded cash before. Like before I knew about life insurance, you have to realize I was in this weird spot where I had been with Wall Street, right? And then I realized that was bad, and I hadn't yet found out about the sacred account. So if you know my story, that came a little bit later. So there's this weird like financial purgatory, if you will, where I was like, I don't know where to put this stuff. I'm making it, I don't know where to put it. So I was just putting it in cash. Now, what happens is when someone's keeping their money in cash, it's by default, right? You earn it in cash, it's the currency. So it is kind of just like an easy, almost a laziness. Like I don't want to put it somewhere else. It's easier just to keep it here. And it's also something we're very familiar with owning. Now, I say specifically familiar with owning because familiar with owning it doesn't mean we're familiar with it, right? The reason why someone wouldn't do a sacred account, the reason why someone wouldn't do gold and silver, the reason why someone wouldn't do a real store of value is because they're afraid of the risk that comes with it because they don't actually understand it. Okay, that, or maybe they got ripped off, or they're afraid of getting ripped off, or they ripped other people off, so they're afraid someone's going to do it to them. Very small percentage of the time it's that. Usually it's they're afraid of the gold and silver, they're afraid of the life insurance because it's new and it's different and they don't totally understand it. Now, this is one of those things where it's kind of like you don't understand the cash either, you just don't know you don't, right? So if I'm hoarding cash, I want to challenge anyone listening to go read The Creature from Jekyll Island, okay, to go watch The Hidden Secrets of Money and take our bullion course. And actually understand what US dollars are, where they come from, how they operate, what their value actually is. And if somebody really understands that stuff, they're not going to save in cash. Okay. And if someone does save in cash, it's because they don't understand cash, which means, sure, you can do that the rest of your life and stay comfortable, but you're violating the very premise of why you won't do a sacred account, why you won't do gold and silver, because you don't understand it. Yet you don't understand cash. So this is a moment of, do I confront the fact that I don't understand cash and learn about it? Or do I sweep it under the rug in the name of comfort and familiarity and continue doing something I don't understand, but turning a blind eye to it, even though that's the reason why I won't do other things that I do understand. So kind of a long answer, but that's something that I would definitely suggest. And I think Avery actually has a suggestion too. Avery says also look up the word dollar and the word gold in the dictionary. Phenomenal answer. I'm actually proud of that answer. You definitely look those up. The definitions of words are telling, and also the etymology of words are very telling. All right, we have a question from Rima. Let me bring Rima on live here. All right, let's see if Rima has a mic. Can you hear me, Rima?
Yes, I do. Can you hear me?
I can, yeah. Am I saying your name right?
Yes, Rima. That's
okay,
right.
Awesome. What is your question tonight?
I'm sorry, I'm new to your webinars. I've been probably a couple of times, but you keep referring to making a deal once or twice a year, and I'm not sure what deal you're referring to.
Okay, good question. So Rima's asking, what does it mean when we talk about making a deal? Essentially, that's investing, right? And so you're looking at a deal, meaning an investment, and you're putting money into that investment. And so when you're looking at making a deal, you're looking at investing essentially. So when we talk about the once or twice a year when you're financially independent, you're making an investment once or twice a year into a real estate deal or a private lending deal. And so that's what that means. And by the way, I love that question because it's honest. I think a lot of new people are afraid to ask that kind of stuff. By all means, there's no such thing as a dumb question. I had a teacher in 10th grade, and he said, I would rather have you feel like an idiot for 5 seconds asking a dumb question than to actually be an idiot for the rest of your life because you never asked and never figured out the answer. So acknowledgement to Rima there. That's great.
Oh, can I ask you another question?
Go for it. Yeah.
So do you help people to make the investment? Is that what it is that you're doing? Help the investment or do the real estate deal?
That is something. Yeah, that is something we do. So we have different deals that we connect clients with, and that way they're able to get connected with deals that we know have a good proven track record. They have good managers. They're going to pay on time. Those are the types of things we look at. So when a client gets to that point in time, that definitely is something we walk them through. And then also sometimes clients are more self-starters. They might have their own deals. And so we kind of, look at their deals and make sure that they're aligned with the right things and have all the right boxes checked as well.
Great. Thank you. Well, I'll be in touch. Thank you.
Absolutely. Okay. We have a question here from Kevin. Let me bring Kevin on live tonight. And this is awesome. I get to talk to everyone tonight. Is this Dr. Kevin Krasak?
Hey, how's it going?
Hey, Kevin, how are you tonight?
Good.
Awesome. Well, what is your question?
I don't know. I think I get the concepts. I think my biggest concern now is that I just have so much debt. I have to make a lot more money. So obviously I have a health clinic, I have personal stuff and just debt and student loans and things like that. And, I'm constantly frustrated because I'm like, I want to invest right now, but I got to get the debt paid off. But when the debt's so much, it's like my only option is just make more money. But I feel like I'm kind of stuck in a cycle where, I'm a chiropractor, an exercise physiologist. I teach nutrition. I adjust people and do rehab. Like I'm basically selling my time and services for money, right? So I want to get past that point. I would love to do more online type stuff. So I am getting set up with Ryan or Robert Sislow, who you recommended, just to try to get some videos produced and things like that. But I just want to learn more of the mechanics of the actual production. I talked to Lexi about that. Sorry, that was just a random comment. I don't know if that's relevant to this situation, but like, what else would you recommend? Like, if someone was to produce products, like where would you start? Like, let's say you just want to make more income. Like, what would be your first product?
Yeah, that's a good question. So Kevin is basically asking, how does he increase his income? He's a chiropractor. And so he's got, it's a skill set for sure. But like you said, it requires his time to be there. He can't have other people doing the adjustments for him. So, for me, and this is something you'll probably pick up working with Robert, start with content, right? Like I can't tell you how many people try and crack their own back. I'm one of them, right? Like they're going to do it. Maybe make like a content, like videos. You're not advising them to do it, but hey, if you're going to do this, like here's something helpful that will help alleviate pain. I think that's a way to take your time off of doing the adjustment. That's just a random idea. But Kevin's right. The main thing I'd be focused on right now, if I was increasing the income and growing that. And actually, Justin has a good suggestion. Supplements. I know, Kevin, you've tried supplements and maybe have supplements, but Justin has through his business maybe a way that you can monetize through supplements as well. And then on the student loans, Kevin, I would connect with, and I sent you a couple of videos, connect with our debt program, see about that. Student loans are something we can help reduce. We have our debt validation program. We can enroll those. And potentially get those cut in half and get you out much sooner as well. And granted, like anyone in Kevin's position, whether you're a chiropractor, whether you're a doctor, whether you're an attorney, where you have a lot of debt from education, usually that does mean you have great earning potential. And granted, you might be burnt out from doing the school, and it's usually high intensity production with that type of work. But I would really hammer down and try and produce as much as possible and try and get the debt taken care of in just a couple of years. Because once you're done, you're out and doing, if it's $250,000 in debt, that's kind of like doing a $250,000 deal or investment that's going to pay you cash flow for the rest of your life, because now you keep all those payments that used to go towards the debt. So excellent question there from Kevin. All right, let's see here what else we have. William had the same question about doing a deal. Awesome. I'm glad Reem asked that. Yeah, anytime I'm talking and you guys are like, what the hell did Jerry just say? Assume nobody else knows also. And I'll share this story as an example of that. When I was at this, probably 2 weeks ago, I think I was in Dallas. I was at an investing event, and it was heavily focused on oil and gas investing, right? So buying oil fields, buying production there. And it's a room full of CPAs, and it's a room full of, family offices and attorneys and advisors and people that understand finances at a very deep level. Well, the presenter kept on using a phrase, and I won't use it because I don't want to give everyone else confusion on what the phrase was, but he kept on saying the same phrase over and over. Right? He'd whip it out, he'd say it, and then he'd be talking, he'd say it again. And I didn't know what the phrase meant, and I thought I was the only one. So I turned and I looked at the guy next to me, and I knew he was a CPA, and I was like, hey, when Nat says this phrase, what does he mean? And the guy's like, I don't know. And then I talked to the guy next to him. I was like, hey, do you know? He's like, I have no idea. So like these two guys that are next to me, one of them has been in the industry probably multiple times over how long I've been. I've been at this 10 years. He's probably been at this 20 or 30 years, has no idea what this presenter is saying. Right? I thought I was the only one. So I go and ask the presenter, hey, what do you mean when you say blah? Okay. And he explains it. And it was something really simple that I understood. I just didn't know how he was saying it. Just like with Rima's question, she knows what investing is. She just didn't know what is, doing a deal mean. Right. And so I love those types of questions. Let me see if we have anything else here on Facebook, on Zoom. If not, we're going to tune out and call it a night. All right, that looks like it on Zoom. Let me just check on Facebook here really quick. Let's see. Justin has a comment. I think I blew some of my teammates' mind yesterday when I told them that my goal is to double where we are currently. That's awesome. I know Justin is expanding into Mexico. Mexico, actually, there's some tax benefits there, Justin. We'll talk about that. Yeah, I think that's all the questions we have, guys. So I'm going to log out for tonight. We'll be back next Friday. If you guys have not gotten a copy of my book, Blueprint to Financial Freedom, grab one. I don't have a copy with me, but you guys can go to jerryfetta.com/B2F and you can learn more about the different phases we talked about tonight. If you're brand new, that's the best starting point, because then you can start to go over what those phases mean, some of the things that you hear me saying, and then you can jump on a call with my team and get further educated on it. Make sure that you're tuning in again next week. We'll be back at the same time. You have to excuse my background is different. Lexi's not here, so she's not here to help me set up the camera all pretty and stuff. So we'll thug it out on the webinar one more week before she's home, and I will see you guys next time. All right, have a great weekend, everybody.